The Essays of Warren Buffett Part 6, The Truth of Numbers and the Final Lesson. In Part 5 we saw that Buffett does not consider a deal good, just because it is big. For him, the real test of a merger and acquisition was, is the buyer truly buying value, or just a beautiful presentation? There the question of intrinsic value, owner earnings and accounting numbers was left incomplete. Because a company can show a profit in the report, but real wealth might still not come into the owner's pocket. Now in the final part, the story reaches that room where many investors get deceived the most: financial statements. Numbers look calm, look legal, but sometimes the biggest illusion is hidden behind those very numbers. An investor is reading an annual report at night. Net income is up, management is confident, and everything in the report appears according to the rules. But suddenly Buffett's question echoes in his mind: is the accounting telling the truth, or is it just making a number that looks like the truth? Right here, the final mystery opens. Because Buffett warns that accounting rules are necessary, but the investor's understanding is even more necessary than them. Whichever reporting method a company uses, according to Buffett, the investor should ask 3 questions. What is the company's real worth? Will the company truly be able to fulfill its future obligations, meaning the responsibilities to come? And third, how capable and honest are the company's managers? Because sometimes, the people making the numbers are more dangerous than the numbers themselves. GAAP, meaning Generally Accepted Accounting Principles, is the standard framework of accounting. Its job is to make financial information organized and comparable. But Buffett's point is that GAAP is necessary, not sufficient. Reality can be blurred even while following the rules. Meaning, the problem is not always illegal fraud. Many times, legal accounting choices can also give the investor wrong comfort. A company can present its numbers in such a way that the report looks technically correct, but the economic truth is not completely clear. Right here, the game of accounting shenanigans begins. The investor thinks that he has read the truth, whereas he has only read a carefully arranged version. Net income is the most popular example of this. People see the headline "Profit increased, the company is strong, the story is right." But Buffett asks, what is included in this profit and what has been left out? Realized gains come from an actual sale, while unrealized gains can appear on paper. The economic meaning of both can be different. If the investor does not understand this difference, he can mistake accounting profit for cash-like earning. And that is where the mistake begins. Buffett and Charlie Munger did not like playing with numbers, but they knew that many corporations could do so. Therefore, they stopped the investor from looking just at the reported number. They say understand the machinery behind the number. Another trick is the restructuring charge. In reality, this can be the one-time cost of business reorganization. This can be legitimate. If a company is closing a factory, doing layoffs, changing systems, then cost will surely come. But danger comes when past mistakes are put into a single event. Like management says, just this once a big hit has been taken, everything will be clean ahead. Buffett explains this with a story like a golfer. A golfer plays a very bad score, then says that he restructured his swing. Now he makes the bad score a separate event and shows the rest of the numbers as smooth. The investor feels the performance is stable. A company also does the same many times. Put losses into a big restructuring charge, then show future earnings as clean and tidy. Meaning, the real business has not become that strong, just the presentation of accounting has become smoother. Here the final lesson is very practical. If a cost is truly one time, then fine. But if every few years a one-time cost keeps coming, then it is not one time, it is a business pattern. The investor should ask, is this an unusual event or management's regular habit? Now comes the matter of acquisition accounting. In Part 5 we saw that the value exchange in a merger must be fair. But after the acquisition, the accounting method can also change the reported earnings. Previously, companies used methods like purchase accounting and pooling of interests. In purchase accounting, assets and liabilities were recorded at fair value. In pooling, historical book values were combined, due to which many times the accounting impact of the deal looked different. The Financial Accounting Standards Board eliminated the pooling method starting from 2001 so that the reporting of acquisitions could be more transparent. But Buffett's broader point is alive even today. As soon as the accounting method changes, the same deal can show a different picture. Therefore, the investor should have a basic sense of accounting rules. Becoming an expert accountant is not necessary, but blind trust is dangerous. Goodwill is also a part of this story. When a company buys a business at a price higher than the book value, the difference can go into goodwill. Goodwill can be right when the business bought truly holds earning power. But if the deal turns out bad, goodwill can be written down in the future. Meaning, excitement is visible at the time of acquisition, and the real pain lands in the financial statements several years later. This is why Buffett keeps an eye on the numbers even after the deal. The purchase price is just the beginning, the final truth is visible in the business performance. Now comes the matter of segment reporting. Previously, many companies could hide a lot in a single figure. But when separate information of subsidiaries and segments comes, the investor can see which business is truly good and which is just hidden in the group. In a company like Berkshire, there are different businesses: insurance, utilities, manufacturing, retail, services. The economics of every segment is different. If everything is mixed into one number, it can be difficult for the investor to understand the real engine and the weak spots. Right here, the value of transparency is visible. Good reporting rules give more light to the investor, but the responsibility of looking still remains with the investor. Pension liabilities are also a similar hidden area. A company can show a profit today but can hold a big responsibility to give pensions to employees in the future. If this obligation is not understood correctly, the real financial strength of the business can be overestimated. Buffett's eyes always remain on future obligations. Because a liability may look like a small line item today, but can eat up cash flow in the future. Now we come to tax matters, and here too Buffett shows complex reality in a simple point. Tax is not just money given to the government. Tax can change business economics, consumer prices, shareholder returns and capital allocation. The Tax Reform Act of 1986 brought several big changes in America. The corporate tax rate decreased, but the impact fell differently in areas like capital gains. Buffett does not look at this as a complaint. He wants to understand between whom the tax change divides the economic pie. Some people think that if corporate tax reduces, consumers will get the benefit. Some believe that the benefit will go to corporations and shareholders. Buffett says the answer depends on the nature of the business. The tax benefit does not pass the same way in every company. If the business is regulated, like an electric utility, the impact of the tax change can reflect in prices. Customers can get the benefit. But in an unregulated business where the company holds pricing power, the benefit of the tax reduction can remain with the owners. Buffett gives the example of a brain surgeon. If the surgeon's tax gets reduced, will the surgery fee automatically decrease by that much? Probably not, because price is not decided just by tax, but is decided by demand, skill, competition and bargaining power. This is the real test of business strength. Who can retain the tax benefit and who has to pass it to the customer? Capital gains tax is also important for Buffett, because Berkshire kept holding high-quality investments for a long time. When the company gives less dividend but value compounds inside, the shareholders' benefit can be visible in future capital gains. When tax rates change, the after-tax return changes. And the investor should always understand the after-tax reality, not the pre-tax reality. The same point applies to the individual investor as well. Frequent trading does not just increase fees, it can also increase tax friction. Compounding is most powerful when money keeps working in the business for a long time and unnecessary leakage is low. Buffett does not talk about shady tricks to avoid tax. He understands tax as a part of business reality. For him, good investing means looking at the after-tax outcome with legal, rational and long-term thinking. Now the final circle of the entire series is complete. In Part 1, we learned that a stock is ownership, not a lottery ticket. Part 2 told that the CEO's honesty and governance is the investor's first protection. Part 3 showed that becoming a business analyst, not a market analyst, is the real edge. Part 4 explained the risk hidden behind safe investment and the power of productive assets. Part 5 told that in deal-making, intrinsic value and discipline are most necessary, not excitement. And Part 6 opens the final truth. If you do not learn to read numbers, you keep your claim of understanding business incomplete. In Buffett's world, accounting is not boring. It is the language in which the business talks to the owner. But like every language, this too can be manipulated. Therefore, the investor will have to know the grammar too, and look at the speaker's character too. The final revelation is just this, that successful investing is not just the art of choosing stocks. It is the art of recognizing the truth. The truth can hide in the market price. The truth can get suppressed in the CEO's words. The truth can hide in the accounting footnotes. And the truth can be scattered in tax rules, future obligations, restructuring charges, and acquisition accounting. Buffett's letters are powerful because they give the investor a lens, not a formula. He says, look at the business like an owner, judge the management like a partner, and read the numbers like evidence. Sometimes the market will scare you. Sometimes the management will impress you. Sometimes accounting will give you comfort. But the investor's job is not to take comfort, it is to understand reality. This is that very final lesson which separates the essays of Warren Buffett from a normal investment book. This book does not give you a shortcut to becoming rich. It gives you the discipline to avoid wrong thinking. Because wealth is not made just from the right stock. Wealth is made from the right temperament, the right business, the right price, the right management, and clear accounting. And above everything, wealth is made from a truth-telling mindset. To yourself too, and to that business too in which your money is placed. When next time you see a company's profit, do not just ask how much the number is. Ask, how was this number made? Can it be repeated? And does real value remain for the owner? When a CEO makes a big promise, ask, is this realistic or just an attempt to please the market? When an investment feels safe, ask, is my purchasing power safe? When a deal looks big, ask, has the per share value also grown bigger? And when the market is in panic, ask, has the business changed or has just the mood changed? This is Buffett's final wisdom. The biggest skill in investing is not telling the future, it is looking at the present honestly. The investor who learns this will not remain calm in every fall, but he will not run blind either. He will not jump on every shiny opportunity, but he will surely build the capacity to recognize the right chance. And perhaps this is the biggest payoff of this series. Buffett does not teach us to win the market, he teaches us to stop losing to ourselves. Because in the end, an investment account is not just an account of money. It also writes the story of your patience, judgment, honesty, and discipline. And when the noise of numbers goes quiet, then one point of Buffett remains: understand the business, recognize the truth, and put money exactly where time can become your companion.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.